Welcome, entrepreneurs! Today, we're diving into an important tax-saving opportunity, vehicle expense deductions. If you use your car for business, whether it's driving to meet clients, delivering products, or attending business meetings, knowing how to properly deduct your vehicle expenses can have a significant impact on your bottom line. In this session, we'll cover the two primary methods for deducting vehicle expenses, the standard mileage rate method and the actual expense method. We'll walk through how each one works, when to use them, and real-life examples to help you understand which method might be best for your situation. Let's start with the standard mileage rate method. This is the simpler of the two methods and is often a great option for entrepreneurs who don't want to deal with keeping track of every single expense. For the tax year 2023, the IRS has set the standard mileage rate at 65 cents. 5 per mile driven for business purposes. That means you can deduct 65.5 cents for every mile you drive, and that adds up quickly. To use this method, all you need to do is keep a log of your business mileage. That log should include the date of each trip, your destination, the purpose of the trip. Let me give you a real-life example to show you how this works. Meet Julie, a real estate agent who drives her car to show homes to clients, attend closings, and meet potential buyers. In 2023, Julie drove a total of 10,000 miles for her business. Using the standard mileage rate, Julie can deduct 65 cents, 5 per mile. So, her total deduction for the year would be $6,550. That's a pretty significant tax savings, right? And the best part is, she only needs to track her miles, not every tank of gas, oil change, or repair. The simplicity of the mileage rate is what makes it a popular option. However, there are a couple of things to keep in mind. If you've claimed accelerated depreciation on your vehicle in past years, or if you're using your vehicle for hire, like as a taxi or rideshare driver, you cannot use the standard mileage rate method. In those cases, you'll need to consider the actual expense method, which we'll talk about next. Now, let's talk about the actual expense method. This method allows you to deduct the actual costs associated with operating your vehicle for business purposes. This includes gasoline, oil changes, repairs and maintenance, insurance, registration fees, depreciation if applicable. If you're using your vehicle for both personal and business purposes, you'll need to determine the percentage of time your vehicle is used for business. For example, if you drive your car 60% of the time for business and 40% for personal use, you can only deduct 60% of your vehicle expenses. This method is a bit more complicated because it requires detailed record keeping. You need to track every expense throughout the year, but in some cases, it can result in a larger deduction than the standard mileage rate. Let's look at another example. This time, meet Tom, who owns a small landscaping business. Tom uses his truck to haul equipment, transport plants, and visit job sites. His truck is crucial to his business, and he spends quite a bit on maintaining it. In 2023, Tom's total vehicle expenses, including gas, oil changes, insurance, repairs, and depreciation, came to $10,000. Tom uses his truck 80% of the time for business, so he can deduct 80% of those expenses. That means Tom can claim $8,000 as a deduction. In Tom's case, the actual expense method resulted in a much larger deduction than if he had used the standard mileage rate. If he had driven 12,000 miles for business in 2023, his deduction using the mileage rate would have been $7,860. 12,000 miles, 65 cents. 5. By choosing the actual expense method, Tom saves an additional $140. So, how do you decide between the standard mileage rate and the actual expense method? Here are a few factors to consider. Compare your total expenses. Start by calculating your total vehicle expenses. If they're high, the actual expense method may be the better option. But if your expenses are low and you drive a lot of business miles, the standard mileage rate could yield a larger deduction. Record keeping. The standard mileage rate is simpler when it comes to record keeping. If you don't want the hassle of tracking every gas receipt and repair bill, this method might be a better fit for you. With the actual expense method, however, you'll need to keep detailed records of every expense, plus a log of your business miles to determine the percentage of business use. Evaluate your vehicle usage. The more business miles you drive, the more attractive the standard mileage rate becomes. But if you use your vehicle heavily for business and incur significant costs for maintenance, repairs, and depreciation, the actual expense method could save you more. Regardless of the method you choose, keeping accurate records is absolutely essential. If the IRS ever audits your deductions, you'll need to show your records to back them up. For the standard mileage method, keep a mileage log. You can use a mileage tracking app or even a simple spreadsheet. For the actual expense method, you'll need receipts and documentation for every expense related to your vehicle, plus records showing the percentage of business use. By staying organized throughout the year, you'll make tax time a lot easier and ensure that you're maximizing your deductions. In summary, vehicle expenses can be a significant deduction for entrepreneurs. Whether you choose the standard mileage rate or the actual expense method, understanding how these deductions work and keeping detailed records can help you maximize your tax savings. The choice of which method to use ultimately depends on your specific situation, your driving habits, vehicle expenses, and how much record keeping you're comfortable with. Thanks for joining me today, and I hope this session has given you valuable insights into how to save more on your taxes through vehicle expense deductions.